Tonight, a little extra money is going to land in your account. Maybe it's a bonus, maybe it's a refund, maybe it's just a month where nothing went wrong, and within a few weeks, it will be gone. Not stolen, not lost, just quietly, invisibly spent. You already know this happens. You've watched it happen to you before. But here's the strange part. It isn't a failure of willpower at all. Your brain doesn't treat all money the same way. That single sentence explains almost everything about why saving feels so hard. $1 from your paycheck feels different than $1 from a tax refund. $1 sitting in checking feels different than $1 sitting in savings. The number is identical. The feeling is not. And feelings, it turns out, run your financial life far more than logic does. Economists used to assume money was money. $1 was $1 wherever it came from, whatever account it sat in. This idea even had a name. It was called fungibility, and for most of the 20th century, it was treated as an obvious law of economics, almost too simple to question. If money is truly fungible, then how you label it shouldn't matter. Rent money and vacation money and grocery money should all just be money. But is that how it actually feels to you? In the 1950s, the economist Milton Friedman proposed something called the permanent income hypothesis. His idea was elegant. People don't spend based on the money in their hand today. They spend based on their expected income over their entire lifetime. A windfall in this model should barely move your spending at all. You'd save most of it, smooth it out, treat it like the tiny blip it actually is compared to your lifetime earnings. It's a beautiful theory. It's also, for most people, almost completely wrong. Because real people don't behave like calm, lifetime optimizing calculators. Real people behave like you. And decades later, a researcher named Richard Thaler noticed something Friedman's model couldn't explain. People weren't just tracking how much money they had. They were sorting it, filing it into invisible mental folders. Thaler called this mental accounting. And it might be the single most important idea in understanding your relationship with money. Here's what mental accounting actually looks like in your life. Money earned from your regular paycheck goes into a mental folder labeled Bills, Obligations, Survival. It feels heavy, careful, guarded. But money that arrives unexpectedly, a refund, a bonus, a gift, gets filed into a completely different folder. Call it the Found Money folder. And found money feels light, disposable, almost like it was never really yours to begin with. This is why a bonus check disappears so much faster than the same amount earned slowly over a month. It's not a coincidence. It's not bad luck. It's a mental label, quietly giving you permission to spend it differently. The dollar amount is real. The psychological weight attached to it is not. Think about the last time you got money back from taxes. Did it go straight into a retirement account? Or did some of it become a dinner out, a new pair of shoes, something you'd been waiting for a reason to buy? For most people, it's the second one. And that's not a personal weakness. It's a documented, repeatable pattern across an enormous number of people, replicated by researchers again and again. There's another economist worth naming here. Thaler Shefrin, working alongside Thaler, extended these ideas into what they called the behavioral life cycle hypothesis. Their argument was that people don't just have one pool of wealth. They mentally divide their money into different levels of temptation. Cash in your wallet is the easiest to spend. Money in a checking account is a little harder to touch. Money locked in a retirement account feels almost like it belongs to someone else entirely. Someone in the distant future you barely relate to. Same total wealth, wildly different willingness to spend it. This is why moving money into a separate savings account, even one with no penalty for withdrawing it, actually works. It shouldn't, according to the old fungibility theory. A few clicks, and that money is back in checking anyway. But mental accounting means the separation itself changes behavior. Out of sight isn't just out of mind. It's out of a completely different emotional category. Now here's the counterintuitive twist. You might assume the solution is just discipline. Try harder. Want it more. Feel guiltier when you spend the bonus. But the psychologist and economist Daniel Kahneman, alongside his research partner Amos Tversky, showed something that flips this entirely. People don't evaluate money in absolute terms. They evaluate it relative to a reference point, and unexpected money resets that reference point instantly. The moment that bonus lands, your brain quietly recalculates your baseline. It no longer feels like extra. This is also why lifestyle creep is so sneaky. A raise doesn't get filed as money to save for the future you already had a plan for. It gets filed as the new normal. Researchers studying consumer psychology, including the economist George Katona decades earlier, found that people's spending habits track their psychological sense of security and expectation almost as much as their actual income. Confidence about tomorrow changes behavior today, even when tomorrow hasn't arrived yet. So if willpower isn't the answer, what actually works? The research points somewhere surprisingly simple, not fighting the mental folders, but redesigning them before the money ever tempts you. The moment a bonus or refund arrives, before it has time to be relabeled as found money in your head, moving a portion of it directly into a separate, harder-to-reach account interrupts the pattern entirely. You're not resisting temptation. You're removing the decision before your brain gets a chance to make it feel casual. This is also why automatic transfers work so well for regular saving. Not because automation makes you more disciplined, because it removes mental accounting from the equation altogether. Money that never touches your spendable folder was never emotionally available to be spent in the first place. You can't feel loss aversion over money you never mentally owned. Think about your own accounts right now. How many folders do you actually have, invisible as they are? Bill money, fun money, savings you tell yourself not to touch, but sometimes do anyway. And what would happen if, for just 1 month, every unexpected dollar that arrived, a refund, a rebate, loose change from a returned item, was moved somewhere it couldn't quietly relabel itself as disposable? Here's what makes this genuinely fascinating, rather than just frustrating. Mental accounting isn't a flaw in your character. It's a feature of how nearly every human brain processes money, built from millions of years of decision-making that had nothing to do with dollars and cents. Your ancestors weren't managing retirement accounts. They were managing scarce resources moment to moment, and the brain's shortcuts for that world don't map cleanly onto a world of paychecks, refunds, and interest rates. So, the extra money you lose every year isn't proof that you're bad with money. It's proof that you're human, running ancient wiring through a modern financial system it was never designed for. The economists who studied this weren't diagnosing a personal failure. They were mapping a universal pattern. And that changes the entire question, doesn't it? It's not why can't you save, as if something is broken in you specifically. It's which mental folder is this money about to land in, and who decided that folder's rules? Because right now, without you ever choosing it, your brain already has an answer. The only real decision left is whether you keep letting it decide or whether you quietly rewrite the folder before the money ever gets there. Tonight, a little extra money might land in your account again. This time, you'll know exactly what it's about to become.